Business is a game of margins, not a game of volume. Hi everybody, my name's Cody Koch. Welcome to the channel where we discuss advanced investing and business concepts. So what do I mean by margins versus volume? Simply what I mean is it's far more important how much profit you make on what you sell than how much you actually sell of something. And I'll explain exactly what I mean by that. This is very important information. It's very important if you're going to invest in businesses, whether they're publicly traded or small mom and pops, if you're going to buy businesses, whether they're big or small, or even just managing the day-to-day operations of your business. You really have to understand the power of margins and what they actually mean for your business. Most of what I'm going to show you today I actually learned from Dr. Lawrence L. Steinmetz, who was a business consultant and pricing expert. There are four major groups of margins. You have your gross profit margin, operating profit margin, pre-tax profit margin, and of course, after-tax profit margin. All four are very important, and there in fact are other types of margins. You can break them down all kinds of ways when it comes to business. But today in this video, we're going to discuss exclusively the gross profit margin as a percentage of sales. Because in a lot of ways, gross profit margin is far more predictive, easier to calculate, harder to manipulate than most other forms of profit margins. And so let me start off with saying this very important statement straight out of the gate. If you own, manage, or invest in a business that's gross profit margin as a percentage of sales gets below its industry average for a few years and doesn't get turned around within the next few, you're either going to get to know a bankruptcy judge on a first name basis, or you're going to decide, we got to get out of this business. This isn't working, we're not making any money, we're going broke. That's the power of gross profit margin as a percentage of sales. And I will show you today exactly how to calculate this, and I will prove to you why this is so important. This is the same regardless of your industry and the size of the business we're talking about. This could be a manufacturing business, retail, wholesale, distribution, construction, doesn't matter. It could be a gigantic multinational business to a really small, tiny micro business. And generally, when I'm talking about a gross profit margin as a percentage of sales for the industry, I'm not talking just for that particular industry, we're talking to the niche and even the size of the business. So it's not just the industry that matters, but it's also the size of the business. The gross profit margin as a percentage of sales needs to be at least in line with your competitors or above theirs. And that will be one of the best predictors of long-term success in the business that you have invested in or you currently manage and own. A lot of people aren't even aware of their numbers. If you've ever watched the show The Profit on CNBC with Marcus Lemonis, in which he helps small and medium-sized businesses who are struggling, you're going to find that a lot of the business owners he works with are often completely unaware of their numbers. This is not a coincidence. You will find many business owners, many business investors, and even CEOs of rather large companies are actually surprisingly unaware of some of these numbers I'm going to show you today. So let's get into the numbers. It doesn't really matter whether this is a business that's selling a product or a service or some combination. The numbers and the statistics are basically the same. So let's say you have a business that you sell a product or service and the price is $100 a unit. Your per unit cost of goods sold is $70 and your number of units you sell per year is 10,000 units. That means your sales are $1 million and your cost of goods sold is $700,000. Your variable costs are $10 per unit, which means $100,000 for the year. Your fixed costs are $100,000 for the year in total, and that means your before-tax net profit would be $100,000. Okay, so we got our information. So what would happen if you cut your price just 10%? How many more units would you have to sell after you cut your prices just to make the same $100,000 in before-tax profit you had before? So let's go through the numbers again. So what do your numbers look like when you cut your price 10%? Your price per unit is now $90. Your per unit cost of goods sold is $70. Your variable cost per unit is $10, which means it's now $200,000 for the year. Your fixed cost for the whole year is $100,000. We quickly run the numbers, do some calculations. Your new sales would have to be $1.8 million worth total for the year. Your cost of goods sold total would be $1.4 million. That means your unit sales, because you cut your price 10%, are going to have to go to 20,000 units just to make the same before-tax net profit of $100,000. So think about what we just showed. A simple price cut of 10% means you are now going to have to sell twice as many units of product or service just to make the same amount of profit as you did before. Now, if that's not bad enough, for starters, ask yourself this important question. If you cut your prices 10%, what do you think your competitors are going to do? Do you think they'll keep the prices the same? Or do you think there's a fairly good chance they're going to cut their prices 10%? In my experience in business, a lot of the time your competitors will cut their prices 10%. And if they do, suddenly everybody's got the same amount of unit sales, but everybody's overall making a lot less money than they did before. But it gets even worse than that. So in addition to whatever your competitors are going to do, because I promise you your competitors are going to constantly adjust based upon what you're doing, if you successfully did that, ponder just for a second what that means for your business as a whole. If you sell twice as many units, that probably means you're going to have twice as much inventory. twice as much accounts receivable, twice as much warehouse space or shelf space in the case of a retail store, maybe twice as many employees. That means that fixed cost number that I gave you is way lower than it's going to end up being. In fact, if you have to double your unit sales just to make the same amount of profit, there's a really good chance your fixed costs may even double themselves, which means in the example I gave you, you suddenly are making zero profit again. What happens when you cut your price? And this surprises a lot of people. It can end up in a death spiral for a business. In many cases, the businesses will never recover. You can see this actually in a lot of examples throughout history. You'll see price wars in a lot of industries where everybody starts to cut their prices really, really low, they get really tight, their margins shrink, and in many cases, the whole chunks of industries will fail. A good example of gross profit margin being so important was the oil and gas industry in the late 1990s, particularly the crude oil industry. Prices had gotten so low relative to the underlying cost of producing oil that in fact, it had become so unprofitable that many players in the industry were getting out of it. In fact, it was so bad there were only a couple of colleges in the United States still offering that degree. And then when oil did its turnaround in 2000, 2001, 2002, and oil prices started to rise again, suddenly these college students, and there was only a very small number of them who had petroleum engineering degrees, came out of college and within a year were making over $200,000 a year salary simply because they didn't have any real competition. Now, let's give another example. Let's do more of a fun example and see what's possible on the other side of things. So what happens, based on the cost structures I've given you, what happens if you raise your prices 10%? So let's go through the numbers. So in this example, we have a price per unit of $110, up from $100. Price per unit of cost of goods sold is still $70 per unit. Our variable cost is still $10 per unit. And our fixed cost is still $100,000 for the year. Your total sales would be $1,100,000 and your total cost of goods sold would be $700,000. Do some quick calculations. If, of course, you sold the same number of units that you did before, 10,000 units, and did not lose a single sale, you would, of course, make an extra $100,000 in before-tax net profit, or in this case, you would go from $100,000 pre-tax profit to $200,000 in pre-tax profit. So let's ask ourselves a question. How many unit sales can we lose and still make the same amount of profit as we did before, the same $100,000 in growth and before-tax profit? So quickly run the numbers, and you will find that your unit sales is 6,667 units. That means your dollar sales will be $733,370. And your cost of goods sold will be $466,690. Your variable cost for the year in total will be $66,670. Your fixed cost will, of course, still be the same $100,000. Your before-tax net profit will be $100,010 in profit. This means that you can lose 33% of your unit sales and still make the same amount of profit as you did before. In this example, if you raised your price just 10%. Obviously, if you raise your prices 10%, one thing that could happen is your competitors can raise their prices. That's the best of anything. But let's say they don't. Let's say they keep their prices the same and you raise your prices 10%. And your sales, in terms of units, your unit sales go down by 33%. What that means is, just like the example I gave before, that means you can have 33% less inventory, 33% less accounts receivable, 33% less warehouse space or shelf space in the case of retail, possibly 33% less employees. This means your fixed cost could dramatically decline simply because you're overall selling less units. This means that your overall profitability can start to spiral upward, and instead of having a downward death spiral by cutting your price, you have an upward spiral of profitability and overall success simply by raising your price, in this example, just 10%. Now, real quick, based on these two numbers, kind of compare the two charts, what you're gonna find is cutting your price 10% versus raising your price 10%. Notice how many unit sales. Notice the difference between the two of them. In the case of cutting your price, you're gonna have to have 20,000 unit sales. In the case of raising your price 10%, you're gonna have 6,667 unit sales. If you cut your prices 10%, or the business you're invested in or you've bought cuts its price 10%, it's gonna have to sell 3 times more units compared to if you raised your prices 10%. And again, 3 times more units means 3 times more inventory, 3 times more accounts receivable, 3 times more warehouse space, et cetera, et cetera. This is often why in some industries you're gonna find some businesses do really, really well and other businesses are struggling very heavily. And as I stated, the number one fear of most business owners, managers, even investors, if they cut their prices, is that they're gonna lose all their sales. Well, I can assure you, very rarely does a business lose all of its sales. One final thought is consider raising your prices just to test what will happen. You'll probably be surprised a large amount of the time by raising prices you actually do not lose very many unit sales at all. We will discuss in future videos how to sell at higher prices and attain higher margins than your competitors. If you found this video helpful and enjoyed it, please like and subscribe. Thank you very much and good luck.